trading as well. So without further ado, I'm going to get straight into the presentation, and then we can hopefully have some time for questions with regard to the presentation or any questions you have after. Just to do some introduction, this won't be a presentation on the wave principle. I'm going to presume that everybody has some basic knowledge of the rules and guidelines. Basically, at its very core, the wave principle is a detailed description of how groups of people behave. And when we apply that to financial markets, this creates specific and measurable patterns. So today, I'm going to show you how we can use these patterns, rules, and guidelines to build a trading plan. In the examples today, I'm using the Forex markets. I'm primarily working with trading Forex markets. However, the very same concepts apply to any asset class. So just keep that in mind as we discuss the examples. So before taking any trade, no matter what your trading methodology, it is highly recommended that you first establish a trading plan. This does not have to be a very complicated task, but it's very an important task. That's really important with regard to your trading career or trading in general. Really, the idea is we want to trade with facts, and we don't want to be trading with emotion. And the very act writing out trading plan will help us when we have to make important decisions, because we will be in a heightened state of emotion when we're trading once we enter that trade. So we're basically going to be influenced by fear or greed, and we need to have a structure or a plan in place that we can deal with those heightened states. Whether you're new to trading or a seasoned risk taker, we've all moved our stops, we've all adjusted our targets, resulting in losing our poor trades. So having a plan would help eliminate this destructive behavior. So there are three core elements to the trading plan, and we're going to focus on them before we look at some Elliott wave examples. So the three core elements that I'm going to discuss today basically is, have we identified a trading opportunity? So have we a setup that we have defined, and has it presented itself? So with an Elliott wave scenario, that would be one of the 5 Elliott wave patterns. We would be looking for either continuation of the trend, a period of consolidation, or a trend reversal. So when we have that presented, we have a focus point, an entry point. And after that, then we have to examine the pattern and see then is there a trend that we can work with regard to the pattern or the setup that we're watching. And then we can use that key level as basically a line in the sand where we'll know if we have to adjust our wave count, or basically in plain English, if we are wrong with our outlook. So then once we have our entry and our stop in place, with the wave principle, we are using it as a forecasting tool. So with that, we can get price projections. So whether we're using the wave principle's guidelines, or how we're actually expecting the price action to unfold, we can incorporate that into our trading plan when we're trying to come up with specific targets. So we'd have maybe the thrust from a triangle, the reversal from a diagonal. We'd expect that to be swift and dramatic, and we'd have the third wave advance within an impulse pattern, often a very strong move. So these would be specific guidelines used. And from having an entry, specific level in the market that we would be excited or we want to enter at, a specific level where we know whether we're wrong, use that as our stop protection, and then we can have our targets. And from those levels, we can create a reward to risk ratio. So that's a very important time to take, because it's important to understand what we're risking for the reward. And that could even decide on whether it is even worth taking the trade in the first place, or can be used then to help us formulate position sizing. So if we have a very, very high reward to risk scenario, we can then use that to position either smaller or greater. But at the end of the day, how a reward to risk scenario is very important, and it's something that a lot of other trading methodologies don't give us, and the wave principle is very good at it. And this is a saying, a very true saying. We've all come across probably various versions of it. This Winston Churchill's version, but like all aspects of life, and taking the time to actually plan, it is harder than it sounds, and it takes discipline and it takes effort. Take even that step back, whether it's like the training plans I'm discussing, literally we take 5 to 10 minutes. And it's just, even personally myself, until I got into this plan, it's a lot easier said than done, turning to a person who will take a plan together and stick by it. So as you've seen there, and really a robust training plan consists really of just those 3 elements. We have an entry, a stop, and we can get some targets. From then, we can create our reward to risk ratio, but also a predefined strategy how we will react once the trade is established is also important. And this is not complicated. It's basically understanding that, for instance, I will get out if this level is viable. So if we've created a level that we're saying stop, when we're creating the plan, no if, buts, or ands of how price action is trading, we will not violate the level where we are using a stop. Then if price actually goes our way, we will have said, I will raise the stop to this level if this happens. I will close out the position if this level is reached. And the fact that we've wrote this down and we've made it a defined plan, this bases the trade on facts and not emotion. However, once we've proven to ourselves that we have the discipline to follow a plan, this is i.e. 20, 30, 40 trades later, where you have an actual booklet of plans that have gone successfully for you. And I don't mean by successful as in financially successful, which you followed the plan. We can then incorporate ways to maybe adjust the plan should we have sufficient evidence to do so. But I'll tell you that this takes a high level of experience to be making those decisions when we are emotionally involved in trade. As we develop as traders, so too will our strategy and our trading plan. But until we get there, we stick to the basics. And if we stick to the basics, you won't feel it until shortly some success, I should ensure, will come your way in any aspect of life, planning.
Cái gì mẹ?
So getting on to the Elliott wave scenario before we quick review of trading scenarios with regard to the Elliott wave model. So this is the 5-wave advance, 3-wave pullback, and we have the first bullish trade setup, which would be when we have 5 waves up for wave 1, corrective pullback for wave 2, potential 3rd wave setup. So we'd be entering on the 2nd wave, completion of the 2nd wave, then trying to take advantage of price action rallying in the 3rd wave. After wave 3 is ended, or should we come across price action that we favor is a 4th wave correction unfolding, we could then take advantage from the 4th wave pullback and trade the 5th wave. And then we have 5 waves complete. We'd be looking then to maybe consider a reversal trade. So we'd be looking for a corrective pullback to unfold. And then within that corrective pullback, there would be an opportunity for a B wave. And here within this textbook example, all of the pullbacks are zigzags, but you know, we do have an alternate or different and 3 different corrective patterns that we could use. So then following a 5-wave setup, basically we have 1, 2, 3, 4, 5, and then we have a 3-wave pullback. We then have a higher wave degree, and something that people are often find it difficult to understand is the wave degrees. If you take the time to study a few charts at different time frames and get your head around wave degrees, it is not that hard to concept, and it's very beneficial when it comes to understanding opportunities, how long an opportunity should last, etc. So this is just an example to show how after 5 waves up, we have the wave degree complete, the correct pullback, and then we'd have this next wave degree. And from this wave 2 low, we would have 1, 2, 3, 4, 5 of another wave 1, 2, 3, 4, 5, and so on. And again, this could be 1, 2, 3, or this could be A, B, C. So it would be a similar setup: 5 waves up, 3 waves pullback, and we'd look then for the following 5 waves. Here now is the bearish opportunities. It's basically the very same model flipped on its side or upside down. We'd be looking to trade third wave down, fifth wave, the reversal from a completed 5-wave decline, and so on. So a basic model, but very beneficial to have this model ingrained in our head, because basically working with 5 waves is basically the structure or the whole backbone of the wave principle. So I'm going to quickly review the 3 core elements that we discussed. Protective stop. This is by far the most important element of our trading plan. We must know when and where we are wrong. It is critical to our survival as a trader, and it's not as negative as people take it on. So having a level where price action can cross by literally a cent or a penny, and we know that what we were looking for is not happening at this juncture, and we need to get out because we're emotionally involved, and then reassess. We can always get back in again. The wave principle is an excellent tool for providing this, because even if you're just learning to count, the very fact that you know when and where you're wrong by applying the rules, this can be a benefit. And while it may be frustrating, building on your knowledge of guidelines, applying them when you're trading as you're learning this skill, and it's very important that you're using your plan and that you're recognizing these key levels where we know we must reconsider our outlook or our trade. Respecting these levels is what's most important. So, as I said, the protective stop is the most important aspect, and it can be adjusted as price trades in our favor, because once other key levels are established from pattern development, we can then use them. It's always nice to get our stop break even, but it's not something that I would rush into doing unless we have the evidence from a key level, i.e. the pattern development, to do so. So with regard to the protective stops, there are basically 3 rules of the wave principle that we would use. So we know that wave 2 cannot retrace more than 100% of wave 1. Same as a zigzag, wave B must not retrace more than 100% of wave A. We don't want wave 4 to overlap wave 1 with an impulse. And then we don't want a greater retracement of 100% within wave C or wave D, the contracting or running triangle. So these are all literally lines in the sand that we can use for each of those patterns, and we can then use that to build our trading plan, basically the backbone of our trading plan around. Getting to our entry, there's going to be a number of entry points, any trade. Basically, we have to decide what suits us, and we can do that then with experience. The whole idea of FOMO, or that fear of missing out, is something that we must understand, and we do not want to be initiating trades under that emotion. So we want to define what we're going to wage for within a setup, and basically we will all have different appetites for risk, or account size, extra, and etc. But with the wave principle, we can actually use the patterns, rules, and guidelines to help calculate specific entry points. So we take a look at that. But understand there is no perfect entry point. So there's multiple ways to enter any trade. For instance, with the wave principle, we could be using a breakout strategy, could be waiting for the pullback. We all know that waiting for a pullback is the safer trade, but you're not going to always get it. And then when price action continues in the direction you were expecting, you do not want to be chasing the trade. So we can use different time frames maybe to help us, but we want to be careful then. I like to use a multiple of 4. So if I'm using a 4-hour chart for my trend direction, I might use a 60-minute chart to create or to look for key levels as entry points, etc. Or else if I'm using a 60-minute chart, I might use a 15-minute chart. I will not use a daily chart and try and get entry points on a 15-minute chart or a weekly chart and try and use the hourly. There's too much of a gap between the trends that are unfolding. So I would encourage you to tighten it up a little bit if that's the case. And sometimes when we're actually trying to get that tight entry, it's often a sign that's telling us that we have a problem with risk, basically. So we're either trying to risk too much money or we just don't want to be wrong. But sometimes we need to think to ourselves about that. And then with our entry, we're going to be able to use that risk to reward scenario. And if we're looking for a minimum of 3-to-1, we can use that. And then finally, when we get to targets, we're looking for where the market get to. So we know there's common Fibonacci relationships between or waves between various patterns. Third wave commonly travels 1.618 times the length of the first. This is not a rule, but it's a guideline that would work. What's most important would be the development of the wave, i.e. those 5 waves that we would be looking to unfold. So in a corrective pattern, we often get equality between waves A and wave C. That's a beautiful guideline that we can use then to create that target. And then trust from a triangle is another very good one. And in the interest of time, today we're actually going to focus on the triangle pattern. So we'll maybe hopefully sometime get together again and discuss some other patterns. But the triangle is actually one of my favorite Elliott wave patterns. So I'd like to discuss it and maybe give some of my experience with it. So here's the list of the Elliott wave triangles. And you can see that there is actually 4 on this chart. But ultimately, the expanding diagonal here at the bottom is a very rare pattern. That's not something that we would be trading in real-time analysis. Generally labeled after the fact because there would be so much corrected price action and breaking to new highs, new lows. So really, when a trading aspect, we would be concentrating on the contracted triangle and the barrier triangle. The only difference being the level or how the BD trend line is established, whether it's horizontal or whether it's contracting. The running triangle is a member of the contract family, except that the wave B does push beyond the origin of the pattern. And you can see here with the contracting, it doesn't. So really, we could boil it down to 2 types of triangles. And if you could spend the time to get these into your head and try and isolate them or spot them in a price chart, this alone could be your trading strategy and trading plan. That's all one might need to focus on one pattern, one outcome. So here's the basic structure of the triangle. We'll quickly review it. It's a corrective structure, meaning that it unfolds counter trend, i.e. against the trend at one higher wave degree. So the trend into the pattern, so here we have the trend into the pattern, will be the trend out of the pattern. The triangle is a phase of consolidation, and we use that phase of consolidation as the setup for the breakout of or the continuation of the trend. It comprises of a series of back-to-back corrective patterns, and they are all from the zigzag family. So they are easy enough to decipher or define. From a trading strategy, I like to take action once wave C is over. So I like to use the end of the C wave as a key level. But if we're excited or we have evidence to favor that wave A has retraced enough and we may consider that it's not time, there isn't enough time, we could maybe enter on the A wave, but at the completion of the A wave. But the C wave is a more conservative approach, and I'll show you that now shortly. And then we enter with the C wave, wait for further developments, and we may even get another entry on the completion of wave E. But keep in mind that triangles can sometimes end abruptly, and we don't want to, we don't want to be chasing the market. If we have been waiting for a triangle to end, and all of a sudden price action thrusts out of it, and we hadn't got into the market. So recognizing a triangle on wave C is a good skill to work on, and then take the trade from there. So if the market is at a juncture where we might expect the triangle to unfold, so there are certain periods of the wave model, i.e. fourth wave of an impulse, or the B wave, or the X wave zigzag structure, we can consider trading this strategy with the following plan. So basically, we recognize that a triangle is unfolding by the sideways corrective nature of it. We know the analysis is not right should we trade below the end of wave A, but if we have evidence wave C is ended, use the wave C low as our protective stop, and then we wait for waves D and E to unfold. We get the thrust out in the pattern, and then once we've evidence wave D is ended, we can calculate the post-triangle thrust measurement. It's from the widest part of the pattern, so from where it originated from, and then extend the AC trend line, and we then project that from the end of the pattern. So that gives us a level to work with. But prior to the triangle ending, the structure that the triangle was part of will also give us other levels that we will be working with at maybe 1 or 2 higher wave degrees. So now let's take a look at a real-time example of triangles that unfolded in US dollar CAD. This was just last month. And these charts that in front of you are taken from the intraday Currency Pro services, which I am the editor. And then we post daily and intraday updates. But getting down to price action, the chart on your right is a 4-hour chart. And we use this really to highlight our trend. In this case, trend is up. Still developing impulse from that level, 132.62. So a quick look back at our trading opportunities slide, and we see here that this is where we are now within this still developing impulse. So we're looking for 5 waves to unfold. We're favoring the 4th wave is in operation, and we're looking to catch the 5th wave with regard to that still developing impulse. And now if we take a closer look at the wave 4 correction, we can see that the price action from the wave 3 peak, well, over here we have from 136.65, it does appear to be 3 waves down, 3 waves up, and possibly now another 3 waves down for wave C. And we would refer to this as back-to-back corrective price action. Basically 2 zigzag structures, and at this juncture, we either have a triangle unfolding or we have a flat pattern. A corrective pullback for wave C, which is now unfolding, red wave C, will favor the triangle. At this juncture, we're expecting lower in the C wave. And even if we take a closer look at the triangle, it does appear a triangle is unfolding within a triangle. Sometimes I would refer to that as the triangles within triangles. But we can see here from this example, if wave C, this purple wave C at 136.34, if this has ended, the remainder of the pattern must unfold below this key level, and wave C could push down here. We have targets for the 78.6% retracement of this red wave B, but ultimately, if this is wave C, must end below 135.34. Trading the C wave decline here is actually a counter trend trade, because we go back to our 4-hour chart. We're favoring that the strength here, this market is up, the trend is up. We're looking for 5 waves to develop to the upside. So if we are to be considering here a downside trade, we must remember counter trend. This is something where we would want to be at our computer trading it in real time area. We wouldn't be setting and forgetting this, because it could be quick trade down, and there's a number of factors that could unfold. But I just want to highlight how we have a key level, we have an idea to take a triangle is unfolding, and then we'd be looking at price like thrust outward. So even on this 1-hour chart, we'd have a possibility of trading a lower time frame triangle. But I want to go back now to the trades that we have been talking about. So here we're watching to see if wave C is unfolding as part of this 4th wave triangle. And if we move on a few days later, we can see that red wave C did end from the thrust of a triangle, just below that 78.6% retrace for red wave B. But those of you with a keen eye, of course, will notice slight adjustment to the internals. We've upgraded to double zigzag. But I don't worry about the complications of the patterns really. What I'm seeing here from a trade perspective is corrective price action, sideways price action, and looking for a key level to work with for potentially an upside trade. So really at this juncture now, wave C has unfolded and we're waiting for the remainder of the pattern to unfold. So going back to our trade plan, we have a pattern we recognize. We have a reason to enter the market for a fifth wave advance. We have a key level to work with at 135.55. So we want wave E to end above wave C. It can't push below it by 1 pip. So we have our protective stop. And we have an upside projection for where wave C will equal wave A 137.41. So we're using the higher wave degree projection, i.e. wave C will equal wave A. So where price action is currently trading, we know where we're wrong, we know where we want price action to get to. So from that, we can actually create a trading plan. We can calculate our risk from our entry point to the key level we're working with, and we calculate the reward from our entry point to the upside target. Then we can divide one by the other, and we get our risk to reward, or reward to risk, sorry. And it comes in here at 2 to 1. So when I talk about 2 to 1 and 3 to 1, with regard to this setup here, I'm favoring this to be a high probability setup because triangle in the fourth wave is common pattern, and then we are looking for a quick resolution, i.e. trust out of it. Therefore, I would be willing to take a lower reward to risk, and I would be quite happy with 2 to 1. And then if we push on 2 sessions later, we can see dollar CAD remained above the key level and remained in corrective mode, and most importantly, 135.55 is intact. We're starting to test the BD trend line. We get above it with evidence the triangle is ended. And even at that juncture, we could raise our key level to 136, because if we're favoring the pattern as ended, we do not want to see price action below this level. So we're getting plenty of information all the time. This is something to take on board with regards to the wave principle. So at this juncture, if we were to raise that stop from 135.55 to 136, we've now reduced the total risk involved to just 18 pips. So we've basically taken 2/3 of the risk off the table. And that goes back to the reason why I'll be willing to accept 2 to 1 scenario, because once we've evidence that the triangle is ended, we're getting to move that stop straight away. Because at this juncture, we're on a violation of 136. It's basically make or break for pattern, and I'm not going to be waiting around to allow for another scenario to unfold. And here we can see the trust did get underway from 136. We were able to establish the post-triangle trust measurement, but notice that it was just above the C equals A projection, what we were basically previously working with. And you can often get that. You understand when you're on the right side of the market or your patterns are adhering to each other. There's harmony within your retracements and projections at different degrees of trend. And here you can see a good example of that, where price action is rallying up to those. So again, at this point, we have met our target, and it's the exact time to close out the trade and leave it. And this is easier said than done, as price action is screaming into your target. You wouldn't be human if you didn't decide to say, price action is doing exactly what I said it would do. I'm just going to leave this market is going to the moon, and I'm going to I'm going to ride it out, because that's what we get here. You have to ride your winners, etc. But that's a dangerous thing to get into. It's much more important to stick to your plan and to have a plan in place and to close out trade with the target met, and then to review your plan and to actually successfully trade it based on the plan. I love triangles because of their swift resolution, and this is something to embrace as opposed to have the fear of missing out. And then just to show you what happened later on, price actually still rallying higher, but then it wasn't until we broke down from the impulse channel we had evidence 5 waves had unfolded. And by the time that happens, we're actually back to where we would have gotten out of the market. See where we broke down from the channel. So it's really at this area we would have been deciding 5 waves are up and done. And this is not too far from where the initial surge got to. So really, having to put yourself through the emotional trauma of actually holding on and waiting to see this price action rally. We've already been through some bit of trauma, maybe waiting for the price action to trust down in the pattern. And when we get an opportunity then to put some targets on bet, that's time to close out. And then you've stuck to the plan, and then that's how you build on it. So here I just want to run through some other examples before we finish up. Very same example in Aussie dollar, similar triangle setup where we have key levels at the end of the pattern. Price action will break it down with a trend line. Then we got textbook trust out of it. Here in dollar CAD, another triangle setup. You can see here where we got some really nice close to the key level. We could actually wait for a breach at the wave D high, but ultimately look for price action to trust higher. This is actually running triangle, so wave B has traded above the origin pattern. That's the running triangle that we discussed. And you see here then where we got a beautiful trust out of it. I just offload another small piece of advice that we've extended boundaries here, and you can see where price action and trades across the apex of the triangle that can often be a period of volatility. So here would be maybe a reason to get out of the market when we cross that level. It can often coincide with completion of the triangle. And finally, my last example is just from yesterday where we were tracking the triangle in euro US dollar. This is a daily price chart on the left. This is our 4-hour chart on the right, waiting for wave C to decline. We do have correct price action off the 109.73 high, which is favoring the triangle scenario. But lo and behold, we didn't get any further downside price action. We got a test to the trend line we were working with. We established from wave B, but we got a brief wave E, and this market or this triangle ended abruptly. So this is a scenario where we wouldn't have got the opportunity to get in unless we considered wave C in place. But I had downside projections looking for retracement to 78.6%. But this is not a reason for me to adjust my trading strategy or my trading plan with regard to the triangle. It's just something that would happen sometimes, and it's a form of don't interfere missing this trade, annoy you. This is just part of the gig, and now we must focus on the trust and see that we get an opportunity to the upside from that. So this is to conclude my presentation. I just hope that you picked up something with regard to creating a trading plan, how the wave principle actually helps us to build a trading plan naturally because we have key levels, we have reason to look for the market to do a certain thing, i.e. forecast the market, and then we can use that then to build a trading plan, and you can add to that with more techniques, etc., as we develop as traders, etc. And then one of my heroes and the all-time greats, Paul Sherlock-Jones, it's no secret that he's a fan of the wave principle, and even from a lot of his sayings and stuff, see that with regard to risk to reward, it's basically what he's often talking about.